Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Soundhound AI Inc. annual report. Soundhound AI Inc. offers a wide range of businesses and services that cater to various industries. The company's flagship product is the Houndify platform, which provides a suite of tools for building conversational voice assistants. This includes APIs for text and voice queries, support for custom commands, and an extensive library of content domains. In addition to Houndify, Soundhound AI offers several other services that enable businesses to deliver conversational experiences to their customers. These include Soundhound Chat AI, a voice assistant with integrated generative AI, Soundhound Smart Answering, which allows customer establishments to build custom AI-powered voice assistants, and Kainet Software, which uses machine learning to enhance how domains work together. The company also provides various specialized services for specific industries, such as Amelia Platform, which builds AI agents for enterprises, Chat AI for automotive, Dynamic Drive-Thru for Gen AI, Voice Commerce, which connects drivers and merchants with Voice AI, Autonomics Platform, Custom Voice AI Solutions, Voice AI Platform, and Soundhound Music App. Furthermore, the company offers edge and cloud connectivity, including embedded voice solutions, automatic speech recognition, natural language understanding, wake words, custom domains, text-to-speech, employee assist, and dynamic interaction, a real-time multimodal customer service interface. Overall, Soundhound AI services are designed to help businesses across various industries deliver conversational experiences to their customers. The stock price of Soundhound AI Inc. has experienced a significant decline over the past year, with drops ranging from minus 15.09% to as much as 50%. Several key events and factors have contributed to this decline. One major factor was the underwhelming debut of its in-vehicle voice assistant at CES 2025. Despite showcasing innovative features, the market seemed unimpressed, highlighting concerns about the company's business model and the hurdles it faces. This event led to a 16.4% drop in stock price on January 8, 2025. Another significant factor was the broader market rotation away from unprofitable growth stocks in December 2025. Despite announcing a major partnership with OpenTable, Soundhound AI's shares fell 39.4% that month due to investor concerns about profitability and cash burn. The company's inability to consistently generate a profit and its significant cash burn have been persistent themes contributing to investor caution and stock price declines. Despite a 99% increase in revenue for 2025, the company still reported a net loss of $14 million. Analysts have noted the challenges in achieving profitability, with some expecting losses to continue in the near future. The intensifying competition in the conversational AI market has also added pressure on Soundhound AI to continuously innovate and secure market share. This competitive landscape has impacted investor sentiment, contributing to the decline in stock price over the past year. Soundhound AI Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Soundhound AI Inc. trades at a higher price-to-book ratio of 7.54 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. Meeting revenue targets is crucial, as it directly impacts the vesting of performance-based awards. Acquisitions also play a significant role in driving revenue growth, as seen with the acquisition of SYNQ and Amelia. Changes in geographic locations, such as the United States, Korea, and France, can either boost or hinder revenue growth. The recognition pattern of overtime revenue also affects revenue growth or decline. Furthermore, the type of service offered, whether it be subscription-based or product royalties, significantly impacts revenue. Additionally, cost of revenues and sales and marketing expenses have a substantial impact on revenue growth or decline. An increase in these expenses can lead to a decrease in revenue, while a decrease can contribute to revenue growth. Understanding these drivers is essential for informed decision-making and navigating the complexities of financial performance. The net income of the company underwent significant changes between 2024 and 2025. Initially, it decreased from a net loss of $367,400 in 2024 to a net loss of $8,624 in 2025, indicating an improvement in financial performance. However, this trend was short-lived, as the net income increased to $129.9 million in just 3 months ended March 31, 2025. Nevertheless, this gain was offset by a decrease of $15.6 million due to loss on debt extinguishment. The profit margins also experienced a decline from 49% in 2024 to 42% in 2025, representing a decrease of -7%. This downward trend can be attributed to the increase in revenue, while net income decreased. The company's financial performance was further impacted by various factors, such as pricing pressures from customers, increased research and development costs, potential loss of significant customer design competitions and service contracts, and compliance with foreign laws and regulations. The reasons behind these changes are multifaceted and complex. Pricing pressures from customers, increased operating costs due to regulatory compliance, and unstable economic and political conditions all contributed to the decline in profit margins. Additionally, market growth uncertainty, competition, customer acquisition challenges, and product development risks further exacerbated the situation. These factors collectively led to a decrease in net income and profit margins, highlighting the need for the company to adapt and innovate in response to these changing circumstances. The company's financial performance in 2025 indicates a positive trend. The operating cash flow for the year was approximately $151 million, which is a significant increase from previous years. Furthermore, the net change in cash and cash equivalents also shows a substantial growth of $50.25 million, indicating that the company has been able to generate sufficient funds to meet its financial obligations. This positive operating cash flow suggests that the company's business operations are generating enough revenue to cover its expenses, resulting in a surplus of cash. This is a crucial indicator of a company's financial health and stability, as it allows for investments in growth initiatives, debt repayment, and other strategic opportunities. Overall, the data indicates that the company is on a solid footing financially, with a strong ability to generate positive operating cash flow. The company's debt level has undergone a significant reduction over the past year. According to the extracted summaries, the debt level decreased from $371,300 in 2024 to $224,387 in 2025, representing a substantial drop of nearly 40%. Furthermore, by December 31, 2025, the debt had further decreased to $133,627, down from $290,974 on the same date in 2024. This indicates a consistent trend of decreasing debt levels. The interest expenses have also seen a significant decline. The data shows that there was a 94% change in interest expenses from 2024 to 2025, with a decrease of $11.5 million compared to the previous year. Additionally, the interest expenses decreased from $5,484 in 2024 to $3,485 in 2025, further highlighting the reduction in financial obligations. Overall, both debt level and interest expenses have experienced significant decreases, indicating a positive trend for the company's financial health. The company's performance was mixed across various segments and regions. On the positive side, international markets experienced rapid expansion and growth, while enterprise customers demonstrated strong long-term partnerships with significant upfront investments. Product royalties and service subscriptions also performed well. In terms of geographic regions, the Americas saw a remarkable 128% increase in revenues, driven by significant growth in the United States. Asia and EMEA also reported substantial increases in revenues at 55% and 58%, respectively. Korea's revenue remained steady over time. However, some regions struggled to keep pace with the company's overall performance. Europe was negatively impacted by seasonal reductions in business activity during summer months, while global operations faced challenges due to rapid changes in government policies and economic conditions. Germany and France also experienced declines in revenue over the past 2 years. The company's management is optimistic about its outlook and strategy, driven by a 3-pillar business model that includes product royalties, monetization, and licensing. Revenue growth is expected to be fueled by the monetization pillar, which is anticipated to become a significant contributor in the future. Management aims to stabilize gross margin as the company scales its business, while keeping operating expenses stable or growing at a rate below revenue in the long term. The company expects to fund its operations for at least 12 months through debt or equity financing arrangements, expense reduction measures, or a combination of both. To drive growth, management plans to increase authorized shares of common stock and invest in software application and development. Acquisitions will also play a key role in expanding the company's AI customer service solutions and creating a voice AI provider for restaurants. However, the company faces challenges related to internal control over financial reporting, including material weaknesses in oversight, experience/training, and controls for non-routine transactions. Management is working to address these issues and align executive compensation packages with shareholder interests through long-term equity compensation. The company has made it clear that it does not intend to pay cash dividends in the foreseeable future. This decision is consistently stated throughout various sections of its documentation, including pages 37 and 45. Furthermore, there is also no indication of any plans for share buybacks. The absence of mention on multiple pages, such as 64, 83, 84, 105, and 112, reinforces this conclusion. As a result, it can be confidently stated that the company has not paid dividends or bought back shares. That concludes the financial summary for Soundhound AI Inc. Feel free to comment below, and I will be happy to answer them when possible.